For the thousands in attendance and the millions watching around the world, let's get ready to rumble!
I think it's very clear that yes, the economy is trending towards a recession. Yes, the odds of no recession and that Goldilocks sort of soft landing is only 25%.
Did I stutter just then? Yes.
That is according to The Economist, as we already reviewed. All of that indicating we are trending towards a recession. Inflation goes away, right? As long as we're trending towards a recession, we should see inflation go away. And since inflation expectations are anchored, we really hope that we don't end up seeing a second wave of inflation.
No, Kelly Clarkson!
And this is where the Fed really has to guide us dangerously close to that recessionary line, where, yep, maybe we end up having to dip slightly below before we come out.
Surely you can't be serious.
I am serious, and don't call me Shirley.
So I don't think you necessarily have data that suggests, okay, definitely no recession. While at the same time, I also don't think you have data that suggests, oh, we're definitely in hell over here in terms of the data's so terrible. Right? Consumers still have substantially more savings.
What you've just said is one of the most insanely idiotic things I have ever heard.
And sure, while the excess savings rate has declined, and a lot of people are, in my opinion, using that as, dare I say, clickbait, but I'll go ahead and...
Okay, I'm going to pause right here because there's a few things that he said that I just completely disagree with. All right, he said that the savings rate is actually going up, but it's going down. If you look at credit card delinquencies and you look at credit card debt, it is definitely increasing. He also does say that, you know, there's a 75% chance of a recession, but yet he thinks that this is going to be a Nike swoosh, meaning that it's going to basically come down here, touch this, and lift off again. All right. The only way that Powell pivots, okay, and be clear about this, is if something very, very bad happens. Okay, we're talking a black swan event. Otherwise, he could pause, but that's not pivoting, okay? And he also has a tendency to think that this time is different, that after he does pivot, that we're not going to see another correction in the market, which remains to be unseen. But remember, Powell is a huge fan of Volcker. So he patterns himself after that. So the problem here is Powell will crash the market.
I taught school for 20 years in the inner city, so don't even think about messing with me.
The other thing is, how do you feel about inflation currently? Are you in feeling that it's ticking down? You go to the store, and like we go to the store and buy eggs. He has probably a personal chef. He makes millions. He travels around in a jet. We, okay, are feeling the bottom.
Not entertained? Are you not entertained?
All right, we're going to pivot, and we're going to pivot, unlike Powell, and take a contrarian point of view and see what some of the other people say.
So you're telling me there's a chance?
Are we going to be able to engineer a soft landing to all of this, or are we going to go into a recession? And if so, how bad of one? So I think that's sort of the table that's set here. And I know you got a lot of thoughts about this, so why don't I let you just sort of start running?
I didn't think you had it in you.
I'm your huckleberry.
I do. And so right now we have a very firm consensus that we're heading into a recession. And so you have a lot of people out there saying, well, if that's a consensus, therefore, you know, we won't have a recession, it will be a soft landing, and that's the contrarian bet. My view is that the contrarian bet is that this recession is going to be as bad, if not worse than the 2008 financial crisis. And they see it being a mild affair. And I think that based on what the Fed's done so far, it will be anything but. And, you know, going back to that Fed tightening, I would encourage people to think about the Fed rate hikes that we've seen so far, not as a tightening cycle, but as an interest rate shock. What they've done in terms of the speed and magnitude of rate hikes is utterly unprecedented. And I think one of the reasons why there's so much complacency about this soft, you know, short and shallow recession is that so far the impact of the Fed's rate hikes has been relatively mild. I mean, for sure, we've seen an enormous decline in housing activity. But other than that, it's hard to see where we've had any dramatic impact on the economy. And you certainly haven't seen much of a dramatic impact on the financial markets.
I want my baby back, baby back, baby back, baby back.
And, that's why I go back to the idea that it's an interest rate shock and that so far we really haven't seen the impact. And when we do, that impact is going to be really profound and no one's prepared for it. Bloomberg just reported that in January, large corporate bankruptcy filings were the largest since 2010. Companies shrewdly took the opportunity to lock in the incredibly low borrowing costs that we saw during the pandemic stimulus bonanza. They borrowed a ton short. And we know that because there's $1 trillion in corporate debt here in the US that has to roll this year. And then there's another trillion that has to roll next year. And there's another trillion in 2025. And the only thing I guess that could stave off a significant wave of corporate delinquencies would be for the Fed to swiftly pivot and cut rates back down to where they started from. Because the more Wall Street denies this data and insists the Fed's going to pivot in time to engineer this perfect Goldilocks landing, the harder the Fed has to work to get that tightening of financial conditions that is the mechanism through which the economy will slow and inflation will cool. So it really is a cat and mouse game between the Fed and the markets right now. And basically, since the Fed started tightening in March last year, and they insisted, we're going to be aggressive, we're going to take rates higher, and we're going to hold them there longer than the markets expect. The markets continue to just go, they just don't want to hear it. But, this is the problem for the Fed is how tough are they willing to be to beat it into Wall Street's head that they are going to be more aggressive. And the more Wall Street ignores them, the higher they're going to push rates and the longer they're going to hold them there.
Okay, so who do you think's right? Is Stephanie Pomboy right? Or is it me, Kevin? I look forward to all your questions, and I'd really like to respond to some of them. Again, I'm leaning a little bit more on this thing, and I'm thinking his Nike swoosh is not going to be exactly on par. All right, if you find these videos like this helpful, please like and subscribe and share them with a friend. And as always, have a wonderful and blessed evening.